On this week's episode, we're going to be talking about why diversified expats sleep well at night. This is truly one of the most fundamental aspects of financial planning, and being well diversified is probably one of the most critical aspects of being protected from any kind of financial mishap that might derail your retirement. I really want to talk to the expats out there who, you're working really hard in your day job, you've left your home country, a lot of things are different for expats, the language barriers, working in the local cultures and economies, and there's so many more things to think about, it seems, as an expat. Currency diversification, property. Do you buy one here? Do you buy one back at home? There are so many things to think about. So keeping your finger on the pulse in regards to diversification should really, really help you get a solid retirement plan and a solid night's sleep. So, diversification. Too much money in any single company, and then all of a sudden that company collapses. There goes your retirement. All your money in that one investment property, natural disaster, your insurance doesn't pay out on that property. There goes your retirement. All your money in your one company. Okay, guys, you get the picture. So this is why diversification is so important. This is actually going to be one of the key topics in my up and coming webinar, which is the Expat Investment Masterclass. This is going to be a one-day intensive workshop where we will help guide you, the expat investor, in how you can have a rock solid retirement plan and leave absolutely no stone unturned with your retirement. If you'd like to register your interest in this up and coming seminar, maybe even score some free tickets to it, head to the link in the video description below, register your email address, and we'll get in touch with you. Okay, with diversification, the first thing you need to do is measure, because if you don't measure, you can't manage. So what I've actually done for all the expats out there watching today is attach an Excel sheet in the description below as well. So this Excel sheet is a blank net asset calculator. So, you quite often see your diversification or asset allocation inside your investment portfolios. This kind of zooms out a little bit further than that and takes everything you've got into consideration: your cash, your debt obligations, investment policies, pensions, and it allows you to get a really quick snapshot of where you are currently asset allocated. And that might show up some non-diversification exposure that you didn't realize was there. So feel free to go and download that document. I'm going to be covering off 4 investment types. So we're going to look at property, we're going to look at stocks or shares or funds, we're going to look at cash, and we're also going to look at businesses. So the first thing I'm going to do is tell you why they're all bad. So property. It's an illiquid asset. So if you're 100% in property, and you've got to get a new set of tires for your car, you can't just go selling a window out of your house or the cupboards or anything like that. If the rent doesn't get paid, all of a sudden you've got an asset which isn't paying you an income. So they're very illiquid. They can be hard to or expensive to finance or borrow against if you've moved away from the jurisdiction where you've got the asset in. Say for example in Australia, it's very hard for non-residents to get mortgages in Australia nowadays, and so if you've got a property back in Australia and you need access to financing, you might have to get a offshore mortgage or something like that, and if the interest rate's going up, then it's becoming more expensive. So that's another thing to take in consideration. They're also hugely exposed to tax changes in the jurisdiction of which the asset sits. It's a very, what they call see-through asset class. It's physical, bricks and mortar, quite literally. So in Australia, we had the first homeowners capital gains tax exemption, which, as a lot of Australian expats know, was wiped away last year. So things like that can change. You've also got, insurance risks. If you get a natural disaster or tenants, wreck your property, the insurance might not pay out. And it can also be difficult to manage from afar if you're not living there anymore. Delinquencies can cause problems. And, properties also have high on costs, tax rates, land tax, repairs, body corporate fees, agent fees. Capital growth is variable. You might be having a low yield property and you're really holding out for that big capital growth event upon sale, and the market goes down, so you don't quite get there. So there's a lot of things that are going on with property. Likewise, stocks, being 100% in stocks or shares or in the stock equities market. A stock market crash might take out a large part of your pot. That's just the reality of investing. Having to close negative positions, if you're getting that compounding growth over 5, 10, 15 years, that's fantastic. But unfortunately, having to close down positions has the net negative effect of that as well. Incorrect diversification, can increase volatility and risk. There's obviously a lot of ways to measure that. Alphas, betas, Sharpe ratios, Sortino ratios. There's a whole heap of things that go into managing portfolios that make it easier. But then, the more diversified you are, the lower the returns. That's just a matter of fact for diversification. Just because a little bit is good doesn't mean that a lot is better. What I mean there, for example, if you had the world index, MSCI world index, that's always underperformed something like the S&P 500. But also diversification, if you're going into stocks, if you were to, example, buy 500 of the biggest companies, well, all of a sudden you've got just an S&P 500 basket or index that you've made yourself. And if every one of those trades costs you $1, you've spent $500 in fees you didn't need when you could just buy an S&P tracker. So the next one is the market's constantly changing, so you may need active management if you're going to be 100% in equities. That's another thing to pay attention to. You do need to be on top of it. And the next one is cash. Cash is good as gold. Cash is safe as houses. Cash in the bank. Well, let's look at what's happened to cash in the last 15 years. No longer can expats retire on $1 million cash in the bank at 5% fixed interest, 50 grand a year. Happy days. Back then that was enough to kick up on the beach, wherever you decide to retire as an expat. Nowadays, you're lucky if you get 1% out of cash in the bank. So the low interest returns have really changed that landscape. Inflation just erodes value. As Warren Buffett says, cash, it's the only asset class that's guaranteed to lose you money. So that's another thing to pay attention to. Currency exposures, and cash. Say, for example, use the pound sterling to Thai baht. There is a lot of UK expats in Thailand. If we had a look at it from a high of 56 in August 2015 down to a low of 36.9 in September 2019. That's a 34% drop cash buying power in retirement. That's a very long 3 years for something like Brexit to, upset the apple cart. And then we saw a big rally in the Thai baht. So these are the kind of things to pay attention to as well. And diversification in currency asset classes, even within your investment portfolios, is important as well, for that very reason. Another one for cash is bail-ins. We've all heard of bailouts. Well, geez, if you haven't heard of a bail-in, go after you've watched this video, of course. Google Cyprus 2013 bail-in for the scary nighttime story there for you with cash. That's a reality. The next one is retiring 100% on your business. People get very emotional about their businesses for good reason. We spend all this time of our working life building an empire. A lot of us don't want to let that go, and we see our business as being our retirement plan. Well, businesses sometimes require capital, which is harder to provide when you're in retirement. So, if you have to dig into your back pockets to cover business costs, that might be negatively affecting your retirement. Who manages the business once you retire? Are you planning to retire from the business or stay employed? The 1 foot in, 1 foot out can quite often cause disgruntlement within employees sometimes. So there's a lot of things to think about in regards to that. One of the good things you can do for estate planning, which is not in this video, but we will talk about, is maybe setting up your company in a trust. So placing within a trust with a letter of wishes, so that way if you do pass away, the company can be handled how you want it to. So we'll talk about that in another video. As an expat, what's the best approach to investment portfolio? As an expat, you've got a lot of opportunities that people living back in their home countries don't. You've got exposure to more tools in the toolbox. You can take advantage of being an expat, get better returns, avoid some traps. If you're going to do that though, you need to be proactive. You really need to, put some attention and put some effort into your retirement, guys. Lazy expat investors will run into problems for sure. At a minimum, you're not going to make as much as you could make. In the worst case scenario, lazy expats who don't look after their finances could lose a lot. We've seen this before in the past with expats falling into Ponzi schemes and, losing the lot, inverted commas. Well, the key word there being losing the lot. That straight away shows that people are either lazy or potentially greedy. Obviously, people who invest in Ponzi schemes are being lied to and misled, which is a whole other problem. But if your retirement is important to you and your family, you need to have a level of attention and control here. You should never have all your money, all the lot in any one investment. So that will stop things like that from happening. For me, here is my 5-bucket strategy for diversification. Now, I've done a whole other video on this, which will be up in the top corner right now. So you can go back after this and watch my video on 5-bucket strategy. But I'm going to give it to you guys again because this video is exactly why it's important. So first bucket, cash. You need to have 2 years worth of cash. So whatever you're spending, if you're spending $50,000 a year in retirement, you need to have $100,000. Why? Because if your whole investment pot goes upside down and back to front, you've got 2 years worth of cash sat in the bank you can rely on. So that's the cash portion covered off. This isn't, an exact science and it changes for every single person, but here's how I approach it as a philosophy. The second one is in gold. So gold, precious metals to offset the stock market crashes. Gold being a safe haven. Just keep that there as a backstop if all the equities markets go upside down or the bond markets, inflation like we're seeing at the moment. That's what that's there for. Right in the middle in bucket 3, we've got fixed income. So that's anything that's deriving you an income. That might be property, it might be your business, it might be bonds or loan notes or any fixed income structure. That sits in the middle and that derives you an income. The fourth bucket is blue chip. Guys, stick to the winners, your triple Qs, your S&P 500, your stocks 50, your footsies. Stick to some of the blue chip, low cost, low volatility, high dividend paying guys. That's going to make sure that, even if we do see a stock market crash, they typically fare a fair bit better than a lot of the other sectors. And then the last bucket is growth. Have some exposure to growth. Investors who get scared of risk when they're in retirement also miss out on an opportunity there. So if you're well diversified, that allows you a little bit of room for growth, guys. So, things like 3D printing, VR, biotechnology, all, electric vehicles, all that good stuff. You can have a bit of that in your retirement or your investment strategy if you're well diversified. Obviously, like with everything else, 100%, no. But you can have some exposure to that sector, guys. Dare I even say it? Cryptocurrency. 5 years ago, if you had have invested $1,000 in Bitcoin, it'd be worth $85,000 today. Now, I'm not going to say, go all into cryptocurrency to the moon or anything crazy like that, but, it does make a strong case for having some of it, and if this trend continues to go on the way it has, not over the last sort of 3 months, if you're watching this in July 2021, but, look at it a little bit longer term, it might be here to stay. So, have a look at it. It's worth looking at simply to be diversified. At the end of the day, your retirement is really what this is all about. I do these videos to educate the expats here on what to look out for, give you guys the tools and the toolboxes so that you can really, really, sleep well at night, knowing that you've got all the boxes ticked and, you're not leaving any stone unturned and that you've been exposed to all the different sectors and things to think about so that you can start to put a plan together for yourselves. You've got to do it, guys. Put the effort in yourselves to make sure you get to that retirement goal. That's it, guys. That's this week's video on diversification. Once again, just to recap, like and subscribe if this has been a good video for you guys to watch. Also, have a look in the comments and descriptions below. We're going to be giving away some tickets to our seminar, so make sure you click on the link and register for our Expat Investment Masterclass. And also make sure you download that Excel file, which allows you to set up your net asset values and get a good understanding of where you sit. Thanks, guys. That's been today's video. Have a good one.